Hello, good to have you here. My name is Shedrack Wiles, and in this class, we'll be looking at Introduction to Forex Trading. Now that you have decided to start your Forex trading journey, the first steps is to understand what Forex is all about. You need to understand the terms like pips, lot size, leverage, market sessions, bid and ask price, and the rest. So in this video, I'm going to break it down for you so you'd have a better understanding of how the Forex market works. So let's get started. So like I said, this is Introduction to Forex Trading. So we'll be looking at the definition of Forex, currency pairs, currency quotation, market session, leverage, margin, PEEP, lot size, pending order, bid and ask price. So let's get started. What is Forex? Foreign exchange, also known as Forex or FX, refers to the global market where traders, investors, institutions, and banks exchange and speculate on, buy and sell the world currency. Trading is conducted over the interbank market, an online channel through which currencies are traded 24 hours a day, 5 days a week. Forex is one of the largest financial markets with an estimated global daily turnover of more than 5 trillion US dollars. So now that you can see the amount of money we have out there in the market, it shouldn't be difficult for you to be able to make a little out of that on a daily basis. So the first thing you need to understand is currency pairs. What is currency pairs? In the forex market, currency always trade in pairs. When you exchange US dollars for euros, there are two currencies involved. So the exchange always shows the value of one currency relative to the other. The Euro USD price, for example, lets you know how many of the US dollar it takes to buy 1 euro. Each forex pair will have a market price associated with it. The price refers to how much of the second currency it takes to buy 1 unit of the first currency. If the price of Euro USD currency is 1.3635, it means it costs $1.3635 to buy 1 euro. The forex market uses symbol to designate specific currency pairs. The euro is symbolized by EUR, while the dollar is symbolized by USD. So euro US dollar pair is shown as euro USD. Other commonly traded currency pairs include AUD, which is the Australian dollar, GBP, the British pound, CHF, that's Swiss franc, CAD, that's Canadian dollar, NZD, New Zealand dollar, and JPY, which is Japanese yen. So you need to understand currency quotation. Now we have base and quote currency in Forex. The base currency represents how much of the quote currency is needed for you to get 1 unit of the base currency. For example, if you are looking at Euro USD pair, the Euro will be the base currency and the US will be the quote currency. And as you can see, the base is 1 while the quote currency is this. So a base currency is the first currency listed in a pair, while the second currency is called the quote currency. Forex trading always involves selling one currency in order to buy another, which is why it is quoted in pairs. The price of a forex pair is how much of 1 unit of the base currency is worth in the quote currency. Let me show you what it looks on a real chart. This is MT4 and we have the list of currencies here. USD CHF, GBP USD, Euro USD, USD JPY, and the rest. So the first three letters at the front represent a particular currency, while the last three letters represent another currency. So GBP simply represent Great British Pounds, while USD represent United States dollars. So this is how currencies are quoted in the market. So let's move on. Now we look at market sections. We have the London trading session, the New York trading session, the Sydney trading session, and the Tokyo trading session. The London market opens by 7 a.m. in the morning. That's based on GMT time, and it closes around 3 o'clock in the afternoon, while the New York opens by 12 noon and it closes by 8 o'clock at night. The Sydney opens by 9 o'clock and it closes by 5 in the morning, while the Tokyo opens by 11 o'clock and it closes by 7 o'clock in the morning. What you need to understand about this trading section is this: the market moves better when we have more than one trading section opened. So look at this red bar. This indicates the London session, which starts from 7 to 3, while this is the New York, which starts from 12 to 8 o'clock. And as you can see, between the hours of 12 and 3 o'clock, we have the London and the New York market session open. During this period, there will be a lot of volatility in the market. There will be so much movement, and we have so many traders placing trades. So it is advisable to trade when we have either one or two market sessions open, when there is huge volatility. And by 8 o'clock, the New York session will close, while Sydney section will kick off. And Sydney section will close by 5 a.m. in the morning. And before it closes, looking at this very well, you see that Tokyo session will also open by 11 p.m. So we're going to have another overlapping period. So we're going to have the Sydney section open and the Tokyo section open, which is another good time to trade for those trading from Asian countries. So you can start trading by 7 in the morning. That's if your time is GMT. If your time is GMT plus 1, then it's going to be 8 in the morning. If your time is GMT plus 2, then it's going to be 9 in the morning. So make sure you follow the GMT time. So the best time to trade is when we have either one market open or two markets open at the same time. So watch out for the overlapping periods for more volatility in the market. Now we move to leverage. Leverage trading, also known as margin trading, is a system which allows a trader to open positions much larger than his own capital. Leverage is the ability to use something small to control something big. In finance, leverage refers to borrowing money to supplement existing funds for investment in such a way that the potential positive or negative outcome is magnified. I want you to take note of that place. You are borrowing funds in such a way that the potential positive, meaning if it goes fine, or negative, meaning if it goes bad, outcome is magnified. So if it goes fine, your profit is big, and if it goes wrong, your loss also will be magnified. So leverage is vitally important to your trading, since choosing the incorrect leverage could result in large losses and damage potential profit. So in choosing your leverage, make sure you are not greedy. Now, the amount of leverage on your account partly determines the amount of funds you need to put in for a trade. Leverage gives you, the trader, the ability to trade larger amounts of currency with smaller deposits. So leverage is a two-edged sword. It can help you make a lot of profit. It can also make your account go down to zero. So in selecting your leverage, make sure you are careful. Make sure you don't try to make fast money within a short period. Now we move to margin. What is margin? It is the necessary amount you need to have in your trading account in order to open relevant transaction. Free margin is the available amount of money which can be used to open new positions. You will discover that when you place a trade on your MetaTrader account or any other account you have, the broker will remove a certain amount of money from your account and leave a certain amount of money. The amount of money they have removed is your margin. That is what you can use to place trades. So what you have left will also be taken out for additional trades. Some of you would experience this, those who have been trading already. You have a certain amount of money in your account, you have some trades on, and you want to place additional trades, but it will tell you that you have not enough money, that you don't have enough money to place a trade. It simply means you are out of margin. So let's move on. What is a pip? A pip is the smallest price movement in an exchange rate. PIP simply means point in percentage. It is usually the last decimal place of a currency quotation. It indicates the fourth decimal place in a currency pair, or the second decimal place, that is when it's JPY. So when the price of Euro USD moved from 1.3600 to 1.3650, that's a 50 pip move. So if you bought a pair at 1.3600 and sold it at 1.3650, you have made a 50 pip profit. So let me show you what a pip looks like in the market. So this is the market. I'm sure you can see movement around here. The current price is 1.38 and it's moving very fast. So as it's moving from a particular distance to another distance, we call it pips. So the last four decimal places you are seeing is what we look at. 1.3829, and as you can see, it's moving up and down, and that's how the market works. So when it moves, say from here down to this point, that's 307 pips. As you can see, you can use this tool to know the amount of pips you want to make. From here down here is 72 pips, down to this point is 579 pips. So that is how we calculate pips. So let's continue. Now, what is lot? Lot is the way to measure the position size or the volume of a trade. A standard lot size is 100,000, which is $10 per pip. A mini lot size is 10,000, which is $1 per pip, while a micro lot is 1,000, which is $0.1 per pip. Now we go to bid price and ask price. The bid price represents the price at which a trader can sell the base currency shown to the left in the currency pair. Like I said, the first on the list of currency pair is the base currency, while the second one is the quote currency. And a bid price represents the price at which a trader can sell a base currency. For example, in the quote USD JPY 113.67 over 69, the base currency here is USD, as you can see, and the bid price is 113.67, meaning you can sell $1 at 113.67. Now the ask price. The ask price represents the price at which a trader can buy the base currency shown to the left, which is this. So for example, in this quote, USD CHF 0.9997. The base currency is USD, as you've known, and the quote currency is CHF. And the ask price is 0.9999, meaning you can buy $1 for 0.999 Swiss franc. And the difference between the bid price and the ask price is the spread. So let me show you what the bid price and the ask price looks like on a chart. So as you can see here, we look at GBP USD. This is the bid price and this is the ask price. So the difference between the two values is the spread. So we move to the next. We look at pending orders. We'll start with buy stop. Buy stop orders are useful when the investor believes, with the help of a technical or fundamental analysis, when the price of the market reaches a certain level which is above the current level, it will go further up. So let me show you on a real chart what it looks like. So the market is currently around 1.38. Now, when trading buy stops, we are predicting that the market is still going to come up this way. And we believe if the market can break this resistance line, because there's a resistance line here stopping the market from going further up, and we feel if the market can break this resistance line, it's going to go further up. So we expect it to come somewhere up here. So we can set up a buy stop around here, stating that if the market can cross over to this point, then a trade should automatically be placed. So in setting up a buy stop, you click on new order and on the type, after selecting your asset, your stop loss and take profit, on the type you select pending order and you select buy stop on the list. So then you set your price, which you've seen here, and you click on place after setting your price. So automatically, when the market gets to this point, after breaking the resistance line, then a trade will kick off in your trading account. So that's how to go about buy stop. Let's go to the next one. Now we're looking at sell stop, which is opposite of buy stop. Sell stop orders are useful when the investor believes, with the help of technical or fundamental analysis, that if the market reaches a certain level, which is below the current levels, it will go further down. So let's look at what that looks like. Now, this is the current level we have in the market. The market is somewhere around here. So I'm going to use another line here. Now, we've seen a trend line building here because the market has been finding it difficult to break through. So this simply means there's something here pushing it back. There's a trend line around this area pushing it back. So we feel if the market can break through this trend line, then a trade should automatically kick off. We expect the market to come down here, and we feel okay, once it breaks through this area, then a trade should be placed. So we set up a trade around this area and you go to new order, you select pending order, you select sell stop, and you type your price. So when the market gets to that price, automatically a trade will kick off. So the next on the list, we're looking at buy limits. Limit buy orders are useful when the investor believes, with the help of technical or fundamental analysis, that if the market reaches a certain level price, which is below the current level, then it will go up. So this is another simple one, which simply says when the market reaches a level which is below the current level, then it's going to change direction. So let me show you what it looks like. Now, let me delete these ones. The market is here now, this white line, and we feel if it gets to this trend line, it will not be able to break it and it's going to go up. So we expect it to come somewhere up here. We expect it to come up here. Once it reaches here and it fails to break through the trend line, then it's coming up here. So since we're expecting it up here, so we set up our trade here that should the market get to this point and fails to break at 1.38162, if it fails to break it, then a buy order should be placed and it's coming up here. So you just set your buy limit. You go to new order, select pending orders, and you click on buy limit. You set your price. So sell limit is also the opposite of buy limit. So let me show you that as well. Sell limit orders are useful when the investor believes, with the help of technical or fundamental analysis, that if the market reaches a certain level price, which is above the current level, then it will go down. So this is like expecting the market to hit a resistance line and turn back down, while buy limit is like expecting the market to hit a support line or a trend line and turn the other way around. So let me show you what sell limit looks like. So just like I illustrated earlier, the market is here, this white line, and we feel if it gets here, it's going to find it difficult to break through and it should come down because there is a resistance line here. So you place your trade, a sell limit that should the market get to this point, then we're expecting it to come back down. Then automatically, when the market reaches this level at 1.38600, a sell order will be placed on your trading account automatically without you being online. So that is how buy limit, sell limit, buy stop, sell stop works. They are all pending orders. So let's move to the next. Now we've entered fundamental and technical analysis. This is a very important aspect of Forex that you need to understand very well. This is the foundation of Forex trading. There are two types of analysis. The first is technical analysis, while the second one is fundamental analysis. Technical and fundamental analysis is something you should not joke with. No matter how you understand technical analysis, you must understand fundamental, and no matter how you understand fundamental, you must also put technical into consideration. So the idea behind this type of analysis is that if a country's current or future economic outlook is good, then their currency should strengthen. The better shape a country's economy is, the more foreign business and investors will invest in that country. I want you to dare that. The better shape a country's economy is, the more foreign business and investors will invest in that country. So when a country's economy is doing fine, then we're going to have inflows of investors. We're going to have multitude of people coming in to invest in that economy because of the favorable economic condition. This results in the need to purchase that country's currency to obtain those assets. So as people are coming into that country to buy or to invest, they need to buy the currency of that country. So they exchange their country's currency for the currency of that country. And by so doing, the currency of the country they're investing in will appreciate. So what are the things you will find under fundamental analysis. We're going to have the NFP, which is non-farm payroll, the retail sales, the trade balance, CPI, FOMC, and the interest rate. Those are the kind of news that affect fundamental analysis. And for you to have access to it, just check any of the news sites like investing.com, Forex Factory, and the likes. You will see the things that want to be released, the data that will be released that can affect the market. And I have other videos where I've explained all this NFP, retail sales, trade balance, CPI, and the likes. Now we move to technical analysis. Technical analysis is the study of how prices in freely traded markets behaved through recording, usually in graphical form, of price movement in financial instrument. Now, understand this. It is also the art of recognizing as you identifying repetitive shapes, something that has been occurring over and over, shapes and pattern within those price structures represented by the chart. So technical analysis is simply taking what has happened in time past and using it to predict what will happen in the future. Just as you have seen that whenever market gets to a support line, it bounces back. Why? Because there are clusters of buyers and sellers there. And because that has been happening in time past, about 2 or 3 times in the past, we can use it to predict the future that, okay, when the market gets to this point again, it's going to bounce back. So let me show you an example. Just as we predicted here, we've seen that whenever the price gets to this section, it bounces. When it gets here, it bounces. When it gets here again, it bounces. When it gets here, it bounces. So these are repetitive shapes and patterns that we have seen in time past. And in the future, we can simply see when the market touches this line again, it will find it difficult to break through. It's either it bounces, which will give us an opportunity to follow it down. And if it breaks through, then we're going to follow it up. So we can see that it bounced here and here, and that can give us a hint that, okay, when it comes here again, it's going to bounce. So that is using past data to predict what will happen in the future. So let's move on. So what are the things to look out for under technical analysis? We have so much indicators. We have Bollinger Band, Relative Strength Index, which is also known as RSI. We have Stochastic Oscillator. We have Moving Average Convergence Divergence, that's MACD. We have Moving Average itself. We have Average True Range. We have Parabolic SAR. And we have pivot points, price action. So many things you can put into use under technical analysis. So what makes you a good trader is the ability to combine fundamental and technical together and make sure you don't leave any either behind. Always put into consideration what is happening in the market and also what is happening in the economy. So at the end, you become a profitable trader. So I believe you'd understand the basics of forex trading now. And if I ask you what a PP is, if I ask you for big price, ask price, for spread, market trading sections, lot size, I'm sure you should be able to answer, to give a good answer. So this is the end of this training session. In subsequent videos, I will explain more on other topics in Forex. So it's nice having you around. Thanks for hanging on till now. See you in the next class. God bless.